Have you ever pondered the intricacies of a junk bond and why it might be a daring investment? Well, today we dive into the fascinating world of junk bonds, exploring their key characteristics, the reasons they are issued, their inherent risks, and the types of investors who dare to dabble in them. Picture a corporate bond teetering on the edge of risk, a daring tightrope walker in the financial circus. That, dear listener, is a junk bond, also known as a high-yield bond or speculative-grade bond. Its risk profile is higher than that of its cousin, the investment-grade bond, primarily because it is issued by companies with a higher probability of defaulting on their debt obligations. One of the defining characteristics of a junk bond is its low credit rating. These bonds are issued by companies rated below BBB/Ba3 by Moody's or Fitch, or BB/B by Standard & Poor's. This lower rating signals a higher risk that the issuer might not fulfill its promise to repay the bond's principal and interest payments. But as with most things in life, higher risk comes with the potential for higher rewards. Junk bonds typically offer higher interest rates than investment-grade bonds. This yield, tantalizingly high, is what lures investors to brave the stormy seas of risk in hopes of reaping substantial returns. So, why do companies issue junk bonds? Often it's a strategy to finance growth. Companies may need to raise capital for expansion, acquisitions, or new product development. Enter junk bonds, offering a hefty sum of capital without the need to issue equity. Other times, companies use junk bonds to restructure their debt. By refinancing existing high-interest debt with lower-interest junk bonds, a company can reduce its overall debt burden and enhance its financial agility. However, investing in junk bonds is not without its perils. The primary risk is default. If a junk bond issuer defaults, investors may not receive the full amount of principal and interest owed to them. There's also the risk of market fluctuations. Junk bond prices can rise or fall based on changes in interest rates and overall market conditions. Who then are the brave souls who invest in junk bonds? Often, they are institutional investors, such as mutual funds, hedge funds, and pension funds. These investors have the risk tolerance and resources to manage the inherent risks of these bonds. In conclusion, junk bonds are a high-stakes game in the investment world. They offer the potential of higher returns than investment-grade bonds, but they also carry a higher risk. So before venturing into the world of junk bonds, investors should carefully weigh their risk tolerance and investment goals. Remember, in the world of investments, knowledge is power, and understanding the potential rewards and risks is the key to making informed decisions.